today, I was thinking about what I wanted to talk about, and I'm driving the conference organizers crazy because I don't make any of my talks ahead of time. I always make them the night before because I feel like in crypto, every 24 hours is like a new year. And so anytime I make content ahead of time, it ends up being out of date and completely wrong. So last night I was sitting there after the first day of the conference, and I was thinking, you know, we have such an interesting mix of people in the audience. There are people who are just getting into crypto, who are really looking for institutional grade products to help them get exposure. And then we have a lot of crypto hedge funds, people who've been personally trading, who are really looking to manage their own portfolio. So how do I cover both audiences? And so what I want to talk about today is products and what I like to call potatoes, and I'll tell you more about why that is, the two extremes of the crypto market. So hopefully you'll find it interesting. It's supposed to be a little bit funny and entertaining, so hopefully you'll laugh at my jokes today. So I gave a quick introduction to Digital Currency Group yesterday, but I'll just give a quick overview for those of you who are new. So we are a company that invests in, builds, buys, and supports digital currency and blockchain technology companies. And so what we do is we have three types of businesses. I work at the parent company, Digital Currency Group. We own 3 subsidiaries. They're 100% owned by Digital Currency Group. Genesis is a broker-dealer that buys and sells digital currencies. They're licensed by FINRA and the SEC, as well as the New York DFS. So if you want to buy a large block of Bitcoin, say $10 million of Bitcoin, you can't really go on Coinbase and buy $10 million, right? You'll crash their order book. So you can give Genesis a call. They'll facilitate that trade for you without moving the market. Grayscale is our second business. It's a company that creates financial products in the digital currency space, and I'm actually going to talk about them on the product side, so we'll get into that a bit more. And then CoinDesk. Do people here read CoinDesk? Have you heard of CoinDesk? All right, so CoinDesk is our media events and market data site, and they host a lot of great conferences. Just this fall, they hosted the first institutional investing conference that was very well attended, and in May of 2018, they'll be hosting Blockchain Week in New York along with a conference. The second part of the business is our investment portfolio. So we invest in companies that are building the picks and shovels, or really the technical infrastructure and the applications that support the digital currency ecosystem. So we started investing in 2013 into companies like Coinbase and Ripple and BitPay, really some of the early movers in the digital currency ecosystem. And now we're also investing in companies through this new vehicle, through tokens. And I'm going to talk a little bit about the conflicts of investing equity in companies versus investing in the tokens they issue, as well as some new ways to think about token investing and risk management in the context of constructing a portfolio. And then lastly, we invest in digital currencies themselves. So we were 100% Bitcoin when we launched in 2015. Over the last 3 years, we've obviously diversified as the markets evolved. We now own still a lot of Bitcoin. We're very bullish on Bitcoin, but also Ethereum Classic, Zcash, Filecoin, and a number of other tokens, all of which are disclosed on our website, along with a token disclosure policy, which we feel is important. So my own disclosure, since we are talking about tokens, none of what I say is investment advice. Please don't construe it as such. You should evaluate all decisions on their own merits and come to your own conclusions. I have never been paid to advise, market, or promote any specific project or token. Once that changes, I will let you know. My employer, Digital Currency Group, discloses all of its holdings on its website, and then personally, I own 55 different digital currencies, all of which are listed here. My presentation from yesterday is online. I shared it via Twitter. It's on SlideShare, which is linked to my profile on LinkedIn. So if you want to look at this and look through this, feel free. Great. So yesterday when I was up here, we talked a little bit about, okay, well, what do investors actually do? So the role of an investor really is, in my perspective, is you have to generate return, and you have to offer your investors something better than they would get in the market. And I want to talk about this a little bit because I think in the crypto space, people get very carried away because they look at a particular asset and they say, oh, I bought this asset at 10 cents. And 2 months later, it's at 50 cents. So I did a really good job. I made 5x my money, so I'm an awesome investor. And they forget that they're investing in a market landscape where Bitcoin may have gone up 5x or 6x over that same period of time. So really, it's not alpha they're generating, it's beta. And so I want to talk about that a little bit because I think we have the wrong perspective on how we think about portfolio construction and gains. And then the second piece is, how do you manage or minimize risk? And this is one that's really interesting because the world of crypto today is still very much the Wild West. One of the ways to minimize risk is to take a more conservative investment strategy, a lower risk investment strategy. But the question is always, does the risk of investing in digital currencies today offset any potential outsized returns that may be generated in the future? And when I say the future, the question is not just 1 month or 2 months or a year, it's 5 years, it's 10 years, right? 10 days ago, my portfolio was doing really, really well. Today, after the market sort of had a 30% correction, it's not looking so good. So I think there's always that question for investors of what's the time frame on which we're analyzing these investment decisions. And then the other thing we talked about yesterday was what are the different investing strategies that exist today. So this is a really nascent market. There aren't necessarily a lot of sophisticated strategies that you can use. There are structured products that you can buy. So the one that Grayscale has, which I'll talk about, is the Bitcoin Investment Trust. But there are a number of different vehicles that you can use to get exposure to cryptocurrencies without custodying the underlying or taking some of the operational risk. They're futures products. They're cash settled, which I think makes them a little interesting, a little unique. You can invest in one particular crypto fund, which means you're supporting one manager's particular investment thesis. Or I think what's more interesting is creating a fund of funds or constructing your own fund of funds model where you get exposure to several different strategies. Because there are crypto funds that are very conservative in their approach and view themselves more like venture capital firms where they allocate capital with a 5 to 10 year time frame in mind. But there are also crypto funds that deploy a very actively traded strategy where they're trading on a daily, sometimes even hourly basis. And so those two strategies are fundamentally very different, and they're going to have very different implications for the amount of risk you're taking on. And then lastly, I think the one that I'm excited about, my potato for today, is how do you construct your own portfolio? But more importantly, one of the things we talked about yesterday was homophily, or like-mindedness of people who invest in cryptocurrencies. So if we're all at this conference, we're all investing in digital currencies, we're all on Twitter, we're all on Telegram, we're all part of the same social groups, we're all talking about the same tokens and investment theses, how are we going to generate differentiated results if we're all consuming the same information and trading the same stuff? That's a good question. And so I think that's where constructing your own portfolio is a really, really interesting exercise, and one where I tried a really different approach. I'm going to share it with you. It started as a joke, but it's actually turned out to be quite interesting. So you can give me some critiques on it later on. So I'll talk about products first. So Grayscale, our subsidiary, is creating financial products to enable people to invest in digital currencies. So what we realized in 2013 was that Bitcoin was going to be a new asset class. That was our fundamental belief. And anytime there's a new asset class that requires custody, right? If you own Bitcoin, you don't take physical custody. If you buy gold, for example, you can take custody of a physical bar of gold. Now, how many people here would want to own a physical bar of gold? Oh, wow. I am in Switzerland after all. Okay. So there are a lot of people who have gold in their vaults, apparently. But I think the average person doesn't necessarily want to own physical gold. They want exposure to gold. So in the 1980s, there was this product that was created, the Spider Gold ETF. And before the Spider Gold ETF, the gold market was quite small. But once the Spider Gold ETF came into existence, what essentially was created was a product that enabled people to get exposure to price appreciation in gold as an asset class without having to take on custody and some of the more challenging components of managing gold as an asset. And so we had the same idea with Bitcoin. We said, okay, if Bitcoin is a new asset class, but your average person doesn't necessarily want to do the hard crypto stuff, going on an exchange, buying the Bitcoin, taking on counterparty risk, custodying it, could we create a financial product that would enable people to get exposure without having to take on a lot of risk? And so that's the idea we tested. The Bitcoin Investment Trust launched in 2013. As of yesterday, it had 2.1 billion in assets under management. We then created 2 more products last year. One is an Ethereum Classic Trust. The third is a Zcash Investment Trust. And over the next few months, we'll be launching 4 more individual currency products, as well as a basket product that's a combination of the individual currency products. And again, the premise behind all of these is that people want exposure to this asset class. So we look at AUM growth over time. This is December of 2016 through December of 2017. I apologize, the font's small. You can see that this was really a very, very, very small fund when it first started. And you have to remember, in December of 2016, Bitcoin was trading at about $700. Right? So it's a very different time in the market. And what's really happened over time, as interest in the asset class has grown, you can see AUM has grown dramatically as well. And so the idea is that over time, as we continue adding more products, we'll continue to get more AUM. But more importantly, what we do is we provide a structured product that enables people to take the good side of Bitcoin to participate in the price appreciation without having to deal with some of the downsides. So security and storage, do you have to deal with that? No, we take care of that for you. We actually use Zappo. Ted Rogers from Zappo is here today. We use them as our custodian. We have titled security, meaning that you have actual proof that you own the underlying Bitcoin itself. It's IRA eligible, so what that means in the US is you can buy it in your retirement account and in other tax-advantaged savings vehicles, which is really important because there aren't many other products in the market today that enable you to buy Bitcoin in your retirement savings. And actually, one interesting fact is over the last year, this vehicle, the Bitcoin Investment Trust, has traded at about a 70 to 100% premium to NAV, to the native asset price, because people want exposure to it. And over the last month, this product was trading more in daily volume than McDonald's stock. On average, we were trading 400 to 450 million a day. So I think that's fascinating. For such a small asset, for there to be so much volume and for there to be such a fantastic premium on the NAV is really interesting. I think it's an indication that a lot of people are looking for this type of product. And then lastly, it's sponsored by a trusted manager. And one of the things we've been actively working on is uplisting this product. Today it's traded over the counter in the US, but we want to get it onto a public exchange so that we can get more exposure to the product and more importantly, start to narrow the spread because the spread is a little bit unhealthy today. So this is what a structured product looks like. From a performance perspective, what I think is really fascinating is this is the best performing ETF of all time. So if you bought GBTC at its inception, this is your return. Who here likes that return? Does that look good? Yes? No? No responses. Yes? Yeah. Yes? Yes? Okay. I think that looks really good. I would buy that all day long. And the crazy thing is, even if you didn't get into this asset in 2013, the last 12 months, astronomical performance. The last 3 months, the last 1 month. So this is a great way, if you're new to the space and you're saying, you know what, I don't know that I want to buy and manage digital currencies on my own. Try buying a product. This is not the only one in the market. There's products in Europe, there's products in Asia, but I think, again, structured products fill a very important role into sort of enabling a large group of investors that have a very different risk profile to get into this asset class. So this is the product. Who's ready to talk about potatoes? Yes? All right. So my thesis, this is not me speaking as Digital Currency Group. This is Meltem, the investor, talking now. So and my perspective, I am a risk-loving individual, so my perspective's a little bit different. But I started looking at this whole world of crazy digital currencies, and really the way I view it is, look, there are core protocols. There's your Bitcoin, your Ethereum, your Ripple, your Litecoin. These are protocols that have been around for a long time. Their tokens are traded. There's a lot of liquidity. There's a lot of different markets in which they're traded. I like investing in this stuff, but I don't think it's game-changing. For me, this is a buy and hold strategy. And maybe I'll actively trade. When Bitcoin hit 19,000, I definitely sold some. Good time to sort of rebalance. But this stuff is more buy and hold. There are emerging protocols, so things like Zcash, Monero, Waves, EOS, Tezos, things I'm excited about that are still very young. Maybe the network hasn't even been launched yet. And my approach there is let's take a position early on. Maybe I'll participate in a pre-sale or in a token sale. But those, again, I'm not looking to actively trade these. To me, these are sort of the future building blocks of blockchain-enabled applications. So I'm going to buy these. I'm going to hold them. Maybe I'll participate in some futures trading. But again, buy and hold. So this is all of the passively managed stuff. What I get excited about is the top layer, app coins. And I think someone yesterday called them shit coins, which is a funny way of saying it. But there are all of these new tokens that are coming to market. And to be honest, there are 1,442 digital currencies that you can trade today that are listed on CoinMarketCap. And I don't know what 95% of them do. And I don't care. And here's why. So I had this really fun experiment. It was 4 a.m. on January 10th, and I was awake, and I could not sleep. And I said, you know what? What if I went on CoinMarketCap, and what if my hypothesis was that investors who are looking at investing in digital currencies, who care about a return, I think what they'll look at is price. Why did Litecoin rise so rapidly in price? Because when you went on Coinbase.com, Litecoin was the cheapest digital currency you could buy. People care about entry price. So what if I looked at a bunch of digital currencies where the entry price was under $1, so it's perceived as cheap or affordable, and where there hasn't been more than a 10x rise in the price of that asset yet, where there's still room left to run. And I really think this goes back to investor psychology. People are trying to manipulate a very specific return profile, and that is the return profile of Bitcoin, of Ethereum, of Ripple. You're all looking at me like I'm crazy. I promise you I'm not. We'll get there. So I said, all right, I'm going to pick a bunch of different tokens. I'm going to take a few Bitcoins, and I'm going to just dump some money into this stuff. So I picked, who knows what XCL is? Anyone? No? Elastic. GRS is Gressel coin. Like, I don't know what this shit is, but it's there. They're all, you know, market cap below the top 50. They're the long tail of cryptocurrencies, the stuff that is hard to trade. I had to open accounts on KuCoin. Does anyone use KuCoin? All right. Degenerate traders, I like it. KuCoins, I had to open an account. I was pretty sure all my money was going to get stolen, but it didn't. I had to open an account on Binance, which was also a scary experience. And then I also used Radar Relay, which is a decentralized exchange built on top of the 0x protocol. And that was a fun experience. I'm actually doing a webinar at the end of the month where I'm going to demo how to use a decentralized exchange if anyone's interested. It'll be really interesting. But what I did is I picked all these coins and I said I'm going to construct a portfolio and I'm going to report on daily performance. I'm going to pretend that I'm a fund manager and I'm going to let the world know what's happening. So for a while, remember this was January 10th, right? So for a while, it was really fun because it was a bull market and altcoins were rising. And one of the interesting things I started to pay attention to is even though my US dollar gain was good, because the price of Bitcoin was rising, in Bitcoin terms, I was actually losing value. And this is where indexing becomes a really, really important point. If you're purely looking at dollar gain in your portfolio and you're not indexing back to Bitcoin or a market index, you're actually not tracking true performance. You're tracking beta. You want to track alpha. And to me, whenever in traditional portfolio construction we track return, we look at the risk-free rate. So in crypto, what's the risk-free rate? To me in crypto, the risk-free rate is keeping your money in Bitcoin. And we can debate that, but I think this is an interesting question around how portfolio tracking might work. So my best performing asset was Engine. No idea what that token does, but it was up 34%. And I was like, hell yes, 34% in 24 hours? I will take that all day. And my worst performing asset was Time New Bank. No idea what that does either, but it had a cool name and a cool logo, so I picked it. So here's where we are today. It's day 8 of the Potato Fund. I'm not feeling so good about my investment decisions, but that's okay. And what's really fascinating is if I just indexed to US dollars, I'd be feeling pretty bad right now. But I'm actually feeling pretty good because in Bitcoin terms, I've lost less because Bitcoin is also down. And so what's interesting as we look at this is how we think about indexing and how performance is sort of measured. So here are all my little positions. Here are their tickers. Here's how my performance is compared to US dollars, right? So this looks pretty depressing, I would say. A lot of red. But when I look at my Bitcoin index return, it's not too bad. And I think, again, what I want to emphasize here is as you're looking at different investment opportunities, as you're looking at funds, make sure that you're actually paying for performance. Because your alternative is just buying and holding Bitcoin. And if you look at the return profile I just showed you of the Bitcoin Investment Trust, just buying and holding Bitcoin is a pretty phenomenal investment strategy. If you believe that this asset class is a new institutional asset class, then buying and holding Bitcoin is the lowest risk strategy that you can take. And so I just encourage you all, you're going to hear a lot from different people who are launching ICOs and projects and funds. As you look at what you're paying for, don't pay 2 and 20 for subpar performance. Don't pay 2 and 20 for subpar returns because you could just buy and hold Bitcoin as a product without taking any risk. So that's all I wanted to share. It's been a fun experiment. I'm going to continue tracking the potato fund and reporting on it. The reason I called it the potato fund is sometimes you have to get down on the ground and dig around in the dirt, and crypto feels that way a lot of times. You're like digging through dirt and shit and mud, and you're trying to find potatoes. You're trying to find some good stuff. So that's why I called it the potato fund. Hopefully some of these tokens will be gems, and we're going to test this idea that blindly picking things can lead to return profiles that exceed market return. That's all the time we had. If you want to talk about any of this stuff, please come find me. Hopefully that was interesting. Thanks.